Hello, boys and girls. Today we're going to learn something really cool. So, a few years back, one of the pension funds in one of the countries in Latin America asked me, Tony, we need a strategy that number one, you can invest a big amount of money. The only place that you can invest a big amount of money is the S&P 500 or the bond market. Number two, they want to be long the market because they can't be short. They're pension funds. They want to be long for the long term. And I tend to agree with that because they're printing so much money that you have to be long the market. Number three, they asked me, hey, Tony, I want to have a little margin of error. I want to be safe. Well, there's no such thing as safety, but there is a way to create a trade that can give you a small margin of error. And I'm going to teach you that trade right now. I'm going to teach you the presentation I gave these hedge funds and these pension funds, and how you can get long the S&P 500 with a margin of error. So stay tuned and let's do it. Whoa! What the hell is this, Tony? So, this is where we're going, guys. This is what I want to achieve. But hold on. Hold on with me. So, I'm going to go little by little. I'm going to do it slow so we can all be on the same pace, and we're going to learn together how to create a very fancy trade, a trade that can be used by a pension fund, by a hedge fund, and anybody who wants to be long the stock market with a little buffer. You see, this chart is very complicated and very convoluted. Let's get rid of this. I started doing this and it also seems a little convoluted. So I'm also going to get rid of it, and we're going to start from the beginning. So step number one, the pension fund wanted to be long the S&P 500. So an easy way to be long the S&P 500 is to buy 100 shares of SPY. 100 shares of SPY is equal to 100 deltas. So that's easy. That's very easy. I think everybody can understand this, and we're all on the same page. But this trade has no margin of error to the downside. So what type of trade can we do that has like a stop that can prevent us from going down? So another trade that we can do is, buy. Instead of buying 100 shares of stock, you can buy one at the money call, right? And this one at the money call is equal to 50 deltas. So this at the money call, the positive thing is it already has a stop. The stop is the debit paid. So we're only going to be losing the amount of money we paid for the call. So this helps us a little bit, but we're only long 50 deltas, not 100 deltas, and something else. This trade normally has a bad extrinsic value. And this extrinsic value is terrible because, one of my rules is death before debit. So, one way to get rid of bad extrinsic value is selling extrinsic value against it. So let's go to the next step. So first step, we bought 100 shares of SPY. We didn't like that trade. Step number two, we bought one at the money calls, right? It gave us 50 deltas, which is better because it has a stop, but it has bad extrinsic value. And how do we get rid of bad extrinsic value? So we can sell one out of the money call, let's say, for 50 cents. If we sell one out of the money call for 50 cents, this offsets this a little bit, but we're still paying for this extrinsic value. So if we sell one of the money call, this would be called a long call vertical, starting with the call at the money. This trade is probably a 25 delta call. And so now we're only long actually 25 deltas. Why? Because we started with 50 long deltas, and now we're only long net 25 deltas, which is not exactly what the pension funds wanted. But we're getting somewhere. We started with 100 shares of SPY, which is not a bad trade. We continued with buying one of the money call, which is a bad trade. Why is it bad? Because it has extrinsic value. Why is it positive? Because it has a stop. And then we reduced this bad trade by selling one out of the morning call for 50 cents. Now, boys and girls, let's keep improving this trade a little bit more. Let's keep doing our little work. So if you go back to your trading classes, you know that you can convert these 100 shares of SPY, you can convert these guys into something else. You can convert them into a synthetic. So let's do that. And why is that important? You see, when you were learning math in school, you thought algebra was useless. And in this example, you're going to see how valuable algebra really, really is. So when I was growing up, I used a book called The Baldor, and I think young kids now use something called Kumon. My kids used to hate Kumon. They flush them down the toilet. They hide them under their mattress. Even my youngest daughter used to eat the Kumon because she didn't want to make them. But let's use our algebra skills and let's convert these 100 long shares of SPY into a synthetic, which replicates same 100 deltas. And what is the synthetic of 100 shares of SPY? So we create a synthetic by selling. We sell one at the money put, and simultaneously we buy one at the money call. And this is 100 deltas. So here we can see that this trade here is 100 deltas, and this trade here is also 100 deltas. And it's beautiful, 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 beautiful. So we converted our 100 shares of SPY into 100 deltas. The second trade we were constructing, which is this one, we added one at the money call, that had a bad dollar extrinsic, and it had a good out of the money call with a good 50 cents of extrinsic value. So you see, we're getting somewhere right now. Right now, we are long 100 deltas here on our original long 100 shares. These 100 shares, equal 100 deltas. Here we are. This at the money call, which is a bad trade because it has $1 of extrinsic value. This at the money call, I really, really don't like it very much. And we got rid of 50 cents of the dollar that we're selling. Now, let me give a disclaimer. If you don't want to learn how the sausage is made, that's fine too. At the end of the video, I'm going to just give you the sausage so you can eat it. This part of the video is for the nerds, for the people who really want to understand trading, for the people that are interested in constructing a beautiful trade. And I'm going to go a little faster. So for every 100 long deltas that we have, we can sell one call against it and not be naked. Because, Uncle Tony's number one rule is do not sell naked calls. So Tony does not sell naked calls. I do not like naked calls. Okay. So right now, this at the money call here is not naked because it has one call against it. Now this 100 deltas, since we're long 2 of those at the money calls, and why are we long 2? We're long 1 here, we're long 1 here, so now we're long 2 calls. We can actually do something else. Guess what, boys and girls? We can sell another out of the money call for 50 cents. And guess what? Oh my goodness, this is beautiful. This is a beautiful thing. Why? Because here we're long these 2 at the money calls, and we're short these 2 out of the money calls, making this a zero extrinsic trade, because we paid $1 for this call of extrinsic value, and we sold 2 times 50 cents, eliminating this call. So beautiful. So there we are. So on to the upside, we're protected. We're long double, one time here, one time here, and we're covered 2 times here, eliminating this part of the trade. Now, if you're smart and you know where I'm going with this, you can clearly see that we have this problem, Will Rogers. Here we are. We have this one negative at the money put. And what is the best way, or the easiest way, not the best way, the easiest way to protect the downside? The easiest way is you buy 1 at the money put. Normally puts are more expensive than calls. And let's say you're going to spend here $2 to buy this at the money put. And now we are protected. Why? Because this one has a stop. This at the money call does not need protection because it has a defined risk. But this at the money call does need protection because it has this at the money put that is putting us in danger. So a way to protect ourselves is buying 1 at the money put, but that's paying $2, and $2 is no bueno. So we have to get rid of that $2. And how do we get rid of those $2? It's easy, boys and girls. So we go down here, further down, and we sell 1 out of the money put for $1, and we eliminated 1 of the $2. And if we want to eliminate the second one, well, we have to double our pleasure, double our fun. We would go here and sell a second out of the money put for another $1. And please bear with me because we're almost done with the algebra, right? So let's see, what the hell are you doing, Tony? You are a total idiot. So let's clean up our chart and see what we have. So on the bottom here, we have 1, we have 2 at the money puts. So we're going to go here. We have negative 2 out of the money puts. We know we already did a mathematically correct trade because we sold $2 and we paid $2, and here we paid $1 and we sold 2 times 50 cents. So in extrinsic value, we're doing really well. Now, but what do we have on the other side? On the other side, over here, we have minus 2 out of the money calls. Why? Because we have 1 call here and another call here. 1, 2, here we are. We have 2 puts here we are. So what I'm doing is just cleaning up my little chart. Where it comes interesting is, let's take a look at the middle of the page. If we go to the middle of the page, how many at the money calls we have? So we have 1 at the money call here, and we have a second at the money call here. So total, we are long 2 at the money calls. And we're cleaning up almost every part of the trade. To the left, we're clean. To the right, we're clean. And here's where algebra, Mr. Algebra is going to come in. Mr. Algebra is going to help me out. So here we have one long at the money put, and here we are short one at the money put. So the only thing we're going to do is eliminate. This long at the money put eliminates this short at the money put, and what we're left here is a big nothing, boys and girls. So that was easy. The two at the money out of the money puts are here. The two out of the money calls are here. The two at the money calls are right here represented, and the short at the money put that we put on with the synthetic was eliminated with this out of the money put right here. And if we keep doing algebra, because I'm Mr. Algebra right now, and we divide everything by 2, you see, we're going to end up with, what the hell are we going to end up with, Tony? So you're going to end up with a minus 1 out of the money put, right, for $1 that we collected, which is good extrinsic. We're gonna be left with 1, right, at the money call with bad extrinsic, and we're going to be left with minus 1 out of the money call with good extrinsic. And total, you see, we're going to have a positive trade with an extrinsic value that has double punch, double upside, and it's really, really, really cool. If you guys don't like math, or this was too much crap for you, number one, my apologies. Let's get rid of this crap and let's go to our trading platform, and then we can see what's going on. Let's go and play with our beautiful tasty trade platform. And how do we construct this trade without going the synthetic route? Let's play with the synthetic route one time. So first we bought the 100 shares of stock. Here we are. Then number 2, we did the synthetic. We sold this, we bought here. Then we bought a second call here. Then we sold for half the price. We sold 2 of these puts here, and then finally we sold 2 of the puts down here. Oh, Tasty Trade doesn't let me put 5 legs. So that what I'm showing you right now is I'm just deconstructing what we had. But if we go back to my little graph where we only had 1 long at the money call, then we look for something that's half the price, which is $2.50. We sell that, right? We're left with $2.41. And then we're going to look for a trade that eliminates this $2.41, which is actually this one. And boom, boys and girls, there you have it. Isn't this easy? Isn't this great? Let's take a look at the curve. You see, we're long the S&P. We do not have extrinsic value, and we have a little buffer. Now, this trade does not look very pretty with only 12 days for expiration. This trade has to be done with a little bit more time. You know, the Tasty Trade way is between 40 and 60 days to expiration. And for, learning purposes, I'm going to use 75 days. Once again, I'm going to buy the at the money call for $13.39. And for those who's playing at home, let's look for something that's half the price For ease of use, half the price is 7 for 14. So we still have $5.91. And then we're going to look for a trade that eliminates that trade. So you see, we are left with no extrinsic value, which is absolutely beautiful. And let's take a look at our analysis page. And let me increase this a little bit for you guys, boys and girls. And this is what we have. This is what we have. We have a beautiful long trade, right? That is long from the 494 to the 505, which is a very nice trade. And we're down at the 483. So you're actually long the S&P 500 with no extrinsic value. And let's see what a buffer we have. 494 minus 483 is 8. Divided by 494, we actually have about a 2% buffer to the downside. You see this flat little area here? This flat little area, even if the S&P goes down this approximately 2%, we do not lose money. For you guys that play golf, imagine if we can eliminate the bogeys. So this area is, imagine that we make a bogey here and a bogey there and a bogey here and a bogey there. Imagine if you can eliminate the bogeys from your score. Your golf score would be much, much better. Now, if we keep going down the stock market, then we're hitting the double bogeys, triple bogeys, quadruple bogeys. And, you know, this is trading. This is not magic. At least this trade can eliminate the first 2% down. And in high volatility environments, I can put on this trade with a 4 to 5% buffer, which when we go down, this is even a better, more interesting trade when we go down. And why do I really love this trade so much? Because imagine if you eliminate from your score those negative bogeys. And I'm going to show you something that will blow your mind. What I'm showing you here in this beautiful screen, oh my goodness, no, hide yourself, Tony, hide yourself. So here are the returns of the S&P 500 by month. And what do the colors mean? The green color means the times that the S&P went up more than 2%. That means you did a birdie or an eagle. The white areas are the areas where the S&P, with the black numbers, the S&P went up from 0 to 2%. With the white, with the red numbers, that means that the S&P went down from 0 to 2%. And the red ones are the ones that went down more than 4%. More than 4% represent the double bogeys. You know, visually, we can see that the month of September is not a very, very friendly month. And you don't have to be a genius. You don't have to use the Trader's Almanac to understand that September is not a very, very friendly month. But look at the right side of my little Excel sheet. Look at how many times the S&P is up more than 2%. Even in the year of 2022, which was a terrible year for stocks, the S&P was down 19%, almost 20%. It still had 4 months that went up more than 2%, and it had 1 month that went up from 0 to 2%. And what does this trade really help you? This trade really helps you eliminating all the months that the stock market is down 0 to 2%. And if you see my average here to the right, we are normally eliminating 2.65 bad months of the year from us. What does this mean? So I have back tested this strategy, and this strategy will outperform the S&P 500 by approximately 300 basis points. What does this mean? It means if the S&P went up 10%, you're going to probably make 13%. If the S&P went down 10%, you're only going to be down around 7%. And so this is a beautiful trade if you want to be long the stock market, if you're afraid to buy stocks right now because we're very high, if you need a little margin of error, and if you want to stay long the market and not be out of the market and still play the game. But Tony, thank you for showing me how to place this trade. But now let me teach you guys how to manage this trade. Okay, so in this scenario, 3 things can happen. the stock market rallies up like crazy. If the stock market rallies up like crazy, what we're going to do is this long call vertical. Once we reach 90 or 90%, which is a $9 vertical, once this $9 vertical reaches maximum profit, we're going to take it off. Another benefit when the market rallies up, this short put, right? When this short put, the market is rallying, this short put is going to lose money very, very fast. So you can also close it when it's at 90% winner. And so when this trade is going up, there's really not much to do, right? Because it's very easy. The first thing you're probably going to be able to do is take the long call vertical for a winner. The second thing you're going to be able to do is close the short put for a winner. Or if you're lazy, you can let everything expire and you just collect your maximum profit that is shown here. Now, what happens if the market goes down? So if the market goes down, this call is going to be worth 0. This other call is going to be worth 0. And we're going to have this problem child over here. So on the previous video that I did 1 or 2 weeks ago, I showed you guys what to do if the market goes down to our short strike. What we do if the market goes down to our short strike is very easy. We're going to roll our put down and out. We're going to roll our put down and out to infinity. Why infinity? Because sooner or later, you saw my S&P 500 chart. Sooner or later, the S&P bounces. It's going to bounce hard, and we're going to be able to take this trade off. When you are rolling puts, you do not put another Smart SPX trade on. You wait until this put is positive, you're back to break even, then you close the put down, and then you start again. So you see, this trade is very easy. Let's recap it. So number 1, you buy the at the money call. Number 2, you sell a call that's half the price. Then you find something to finance that vertical, and if it goes up, you close the long call vertical and you close the short put. If we go down, you roll the put until you get your money back. So you see, if you want to be long the S&P 500 with a buffer, there you go. I call this trade the Smart SPX. You can call it the Smart SPY. You can call it the double long. Some people call it the stupid because you're long twice. You're long with the long call vertical. You're long with the short put, and you have a little buffer. You saw my S&P 500 chart where I'm showing all the bad months. This chart. We're gonna eliminate all these numbers here. By eliminating all these numbers here, what's going to happen is when we go down, you're going to lose less money. And if you lose less money, you're going to have to recover even less money. And that is a beautiful, beautiful, beautiful thing. So there you have it. If you want to put part of your portfolio in a long delta trade, do a Smart SPX. Follow Uncle Tony. If you want to grow your pile, follow me here. Follow me on Twitter. Follow me on TikTok. And remember, you gotta risk it to get the biscuit, baby.